The takeaway 3, super loss of selling. The chapter 10 of the book is devoted to selling rules or indicators. So, this particular chapter is very good because most of the trading books deal with the aspect of buying. There are very few books which really deal with selling, because one thing is definitely sure, that selling is much more complicated than buying. So, for buying, you can just go ahead with some metrics and buy it, but yeah, selling is a lot more trickier. The cell rules in this book are very good, and this chapter deserves to be read multiple times. But one thing to be kept in mind is not everything would be relevant all the time. So, few rules like sell volatility when stock is extended. So, this seems simple, like you just see a stock which has gone up a lot and it seems volatile and you get out of it. No, that is not the real case. Actually, there should be some tight rules, like real rules followed, like especially he gives more details, like especially watch for an extended stock whose average daily trading range expands on heavy volume, but while its closing price remains in a tight range. So this means there is an large intraday swing, but the closing price is not too different from the previous day's closing price. So this is an indication that the stock is entering a territory of more uncertainty. So this would be a good time to sell. And then there is one more a point called, it says sell if peers are weakening. So what this means, if you have a stock in a particular sector and you are making good money on it, but there are other stocks in the same sector which are almost similar to this stock, but they are kind of breaking, they are falling down, then there is a chance that your stock also could fall. So this holds true most of the times, but again there are exceptions. Like if it's a company specific problem, like the weaker players are getting eliminated, the survivors get strong. So there will be some exceptions to any of these rules mentioned in this chapter of the book, but I would say this chapter definitely is worth a read multiple times. So moving on to the next takeaway, there is a chapter on major lessons from my failures. This particular chapter was really good, and I liked it a lot. So it's so I would say don't miss this chapter, even if you don't want to read the entire book. This chapter is a must. So he talks about a few things in detail. I have just listed down in summarized points. So no hot tips or risky biotech penny stocks. Yeah, that's a blanket no. Don't day trade or trade in CNBC hot stocks. So he means CNBC hot stocks which you may not know of. See, if you already have researched a stock and it is going up and CNBC covers it, that's different, because you are not entered based on the CNBC's criteria. Then there is another point, he says don't pyramid or use excess leverage. Yeah, of course, leverage is a double-edged sword, but many traders advocate pyramiding. That means adding to your winning stocks, but Jesse doesn't recommend this. So probably it's based out of experience, and there are cases if you tend to trade in illiquid names, this is not something which you should do. Maybe in liquid names it's a different case. Then there is something called avoid feature creep. What this means is, if you have an extremely complex set of indicators, so you would say if moving averages crosses this line and relative strength is this much and volume is rising continuously and last 3 days closing price is on a uptrend, and last 1 week's closing price is on uptrend, and last 1 month the closing price is on uptrend, then I would buy. So that these kind of complex rules are not required is what he means by feature creep. Keep it simple, experiment it, observe it, but keep things simple. That is what is the key message of that. And then don't trade the market, like avoid broad market ETFs, like don't buy the S&P 500 index ETF. And also there is a last point which is the most important one: don't trade with unsuccessful traders. So this is something which is a very different message. So I would say go through it. See, because unsuccessful traders are unsuccessful for a reason. They either lack discipline, lack interest, or lazy. So there could be many factors. So if you trade with them, definitely there is going to be some impact on your personality and your trading performance. So you are not here to socialize with them as traders. You can socialize with friends, that is different, but trading with unsuccessful traders is a definite no. Then moving on to the next one, there is a chapter on inflection point. So this is not a chapter, this is an appendix of the book. So this is one thing which I really liked. So there was a concept called canary in a coal mine. So what is canary in a coal mine? So he explains it very nicely. The whole market is slowly moving up, but your portfolio is not moving up, or rather, it starts performing badly. And if you are adhering to the stop loss, you might be getting stopped out of your positions. So that is what is called canary in a coal mine. But again, you will have to analyze on different fronts, like the percentage moves in your portfolio, and what type of stop losses you are keeping. Whether you are keeping very tight stop loss, is that the reason for it getting hit again and again? So apart from that, there is another a few more signals he talks about in this inflection point. One is a SOX signal, which is the semiconductor index. Then there is a VIX, the volatility index, and then there is something called Robo, which says, I think it's a retail related index. It's a variation of put call ratio with the assumption that retail investors who trade in small lots are dumb money. So this I have not really personally used any of these indicators, but yeah, it may make sense to check these later on. Then I personally am not obsessed with inflection points, but there are since there are many complex factors at play. But yeah, I learned something from this chapter. Like probably I would keep a note of the canary in the coal mine or something of that sort. But I would say this chapter is also pretty good. Then moving on, there are a few honorable mentions which I didn't cover because they are concepts themselves. Like he also mentions about position sizing. So position sizing is a very important concept in trading, which I will touch upon later in some other video probably. Then he also talks about ticker name, which doesn't sound to be too important, but I observed that there are a few stocks in the US whose stickers are catchy and they have been super stocks. So one example he gives in the book is Boom, BOOM. And recently, during the last 1 month or 2 months, the stock Zoom has been zooming up. So the ticker name is quite catchy. And then there are many such things. So it's good to keep a note of that and observe it. So just in there is nothing in the name, but a catchy ticker might attract more momentum traders. Then the focus on small cap stocks is also present in most of his chapters. And he also focuses on stocks which are optically cheap. So he doesn't want to get into stocks which are trading at $100, $200. He's more interested in the $5, $10, $15 stocks. But I don't think he would consider that very stringent. But that is one criteria he mentioned somewhere. Then he also talks about the perils of over diversification. Then there are also some chapters where he talks about swing trading. So I mean that is pretty good. Then moving on to the conclusion, yeah, this is a good book to read if you are a trader focused on self improvement and looking for general direction on charts and practical aspects of the markets. But it would not be a very relevant book for an investor who is very hell bent on his investing rules. So for someone who is open minded, it is good. But for someone who doesn't want to change his thinking, who doesn't like charts, and who is looking for bottom fishing, this is not a book. So you can just skip it. And there are some contradictory points, and there is no real value in trying to prove that the author is wrong. So I would say move on and take the aspects of the book which you like and which you can implement and which can help you in improving your trading performance. So that's it for the video. Yeah, thank you. Hope to see you in the next video with another trading book to review. Thank you.